All right, so today we're basically going to be continuing our series. We're going to continue our series today, and I think what we have next on the outline is um, risk management. If I'm not wrong, yeah, it's here. All right, mitigation. Okay, mitigation is not really a long concept. It's just something very very simple. Um, it just means that one thing should touch the range of the other thing. Okay, so if one range do not touch the other range, then it's not balanced. So that's where we have like an imbalance in price. You understand? So one thing should touch the other. All right. So um, all these weeks, okay, price should touch week to week. Okay. So all these places that the previous week, this week now, for example, you can see that the week here did not touch this week here. So this area right here is an imbalance. Okay. So later we may have price coming down to fill it or mitigate this previous range over here. All right. So now you can basically use you can use mitigation to reduce your supply and demand zones. You can use mitigation to reduce your supply and demand zones. All right. So for example now, let's assume that this for this currency pair now it looks like um you need to even mitigate this. So dollar might still rise up more. Okay. It might not be as long lived as I think it is. So basically now if you are looking at this area, all right, this entire area right here, and you have this other block, you have this other block here, all right. So using the concept of mitigation, okay, using the concept of mitigation, what you can do is that you can refine that other block entry a little bit by understanding that right here there's still a little imbalance there, all right. So the week, you can see this week here, this week did not go into touch the previous week right there, so there's a little bit of a gap right there. Okay, so you can see that your new supply zone will be, or your new zone or point of interest, basically, you can refine it to um from the top to that week. All right, so once price touches the previous week, then that is your mitigation, basically. All right, so until the price gets until the price mitigates the previous candle, this candle here, then this move is now balanced. All right, so um is not more complex than that. So I wanted to say it's more complex than that, but it's not much complex than that. All right, so something very very simple. So if you have an imbalance somewhere, all right, so you have a place near your POI or inside your POI that there's no proper mitigation like that, you can shift it accordingly. You can shift it like that, all right, so that everything will touch and line up just like that. Okay. Um, Another example you can see here. Okay, you can see this area here now. Okay, so you have, instead of using this entire area as your order block, because this is what is your order block from the top to the bottom of the range. All right, so this entire area, that's your order block there. Okay, so instead of using that big area like that, okay, instead of using that big area, you can refine this your entry by um noticing that there is a tiny bit of an imbalance in here, a tiny bit of an imbalance in here. All right, so this week right here did not mitigate this previous week right here. Okay, so that means that you can now shift your point of interest to down at that candle where the thing last got mitigated. All right, so this will now basically be your supply zone, be demand zone. I don't want to complicate this and I don't even want to go too deep into it because it's basically your imbalance theory, all right? Your imbalance and fair value gap, which you guys understand already. So that is what this mitigation is. So you want to look for mitigation in price. You can see this in everywhere. You guys can go and study it more, all right? But just try not to overcomplicate it or just try not to um overdo it. All right. For example, now this right here is one other block on a high time frame. So this right here is one other block. All right. But then there's this little bit of an imbalance here. There's this little bit of an imbalance. All right. So if there's this imbalance here, you can notice that there was a tinier other block in there. There's this first initial one, this first initial candle. Price mitigated it, reached up to even mean threshold a bit. Okay, closing this tiny vacuum block here. There's a tiny vacuum block there as well. So closing that and quickly went lower. All right. So instead of going on a lower time frame to find the exact sponsor candle or something like that, you can easily refine it to where the mitigation last happened. All right. So where is the candle that got mitigated last? Okay. So in this move right here, this candle is not totally mitigated yet. So that means this candle is now our supply zone. So instead of using um the whole huge 3 month order block, okay, you can just use this 1 month order block, this tiny area as your point of interest. All right, so this tiny area will now be your point of interest for price to react at. All right, so you can see price just went into it a little bit and continue going lower. All right, so once that thing gets taken out, then that's a break of market structure. All right, so basically there's not really much to it, just simple imbalance theory. All right, it's just that you're looking a little bit deeper. All right, you're looking a little bit deeper into it to kind of check and gauge whatever you're doing. All right, so this is not what I even anticipated to talk about today. What I want us to talk about today is basically what um risk management is. All right, so what risk management is and um how important risk management is in your trading journey. All right, so risk management and the importance. I hope you guys can still hear me. Okay. All right. So risk management. So the first topic right here is managing expectations. Managing expectations. All right. So a lot of people come into trading with high, lofty expectations. All right. They have this huge, grandiose expectations of what or how much the market should pay them. All right. But and you also see a lot of things on social media. Okay, you see people trying to oppress you, this or that. Okay, many you can see something on social media, and then if you actually allow that kind of thing influence your trade, that actually makes you a weak person, somebody with a weak mind. You get so you see somebody flexing, wasting money that is reportedly forex funds, all right, and then you start over leveraging on your own end. Everybody has their own journey. Everybody has their own path, all right. So the person that you're looking at, you might have been in your own position before and he gradually came out of it, or he was never even in your own position. Probably the person is in a more privileged society. For example, abroad now, you can have your credit cards and you can fund your trading account without having any money. You get, you can basically borrow the money through your credit card and deposit in your account, trade with a bigger account size, all right, and make more money as a result of that. You understand? So might be looking at a trader that is living in another kind of society, in another kind of area. You understand? That's a totally different life to your own, and now be expecting the same results, right? So everybody has their own journey. Everybody has their own stages to pass through. All right. So now you have to manage your expectations as a trader. Don't look at trading as one thing that would get you rich so quick. All right. It's not as easy as it might seem out there. There are also traders that you might see outside now. They will be getting trades with such high RR, right? You might see 1 to 32, 1 to 35, 1 to 50, and they're posting that in regularly. You have to understand that, like I told you guys one time when we found a sponsor account, I told that that thing happens like a few times a year. All right. So don't expect such things. If everybody can make 20% in a trade, 30% in a trade, like everybody that is, or most of those traders that you see on the internet, all right, they're going to be billionaires. The grab. Imagine if I can assure somebody that I make 20% per trade. All right. So let me say I have 10 trades. All right. I have 10 trades and I can make 20R on average. You can see how unrealistic that is. Okay. Let's even do the calculation. Let's do the calculation. All right. Let me show you why they will have been billionaires if that thing is actually real. All right. If that thing is real, they will have been billionaires. All right. So look at this calculator now. So you have um 20% in a trade. So each trade you're risking 1% and you're getting 20%. That's what 20 RRR means. All right. So that means that let's say they have 40% win rate, or let's even say 30%. So that means that out of every 10 trades, they have three losses. Sorry, they have seven losses and three wins. Okay. And those three wins, they're a minimum of 20%. All right. So 10 trades in a month. So you have 10 trades in a month. Out of these 10 trades right here, you have um seven of them are losses. All right. And three of them are wins. Okay. And these three wins, each of them are 20% minimum. Okay. So now let's say you have 20% minimum on these three wins. That means that you have 60%. 60% at the end of the month. All right. 60% profit at the end of the month. Okay. So this 60% profit, they had seven losses. So that means that those seven losses, that is minus 7%, since you're risking just 1% per trade. All right. So they have minus 7%. So that will land you with 53% profit per month. All right, 53% profit per month. Now, many beginners will come into the markets looking for this kind of unrealistic results. All right. You might see RC visionaries, which other traders have WWA, BTMM. There are so many out there that have that show or depict extreme RRR on their trades. Okay, my hard. I see some of them on YouTube sometimes. Okay, so imagine 53% profit. If you have 53% profit, first month, all right. So second month, you have the same thing. Okay, you have another 53%. Third month, okay, it's going to compound and it's going to be a lot of money at the end of the year. But let's assume that it did not compound at all. Okay, so and they had like 9 months where there was money coming in. All right, so times 9 months, that will give you 477% per year. Okay, so that's at the end of the year, your money is five times what it was before. All right, so now if you have this kind of results, like it's insane. Okay, it's insane. It is insane. So that means that you can start with 200,000 now, and then your profit will be sitting at um up to 1 million by the end of the year. If you have such kind of results, you can easily meet any billionaire and ask them, okay, this is what I'm doing. I made five times the money, and this is the record. All right, this is the record here. Blah 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 blah. They could easily give you $100 million, $1 billion. You understand? Depending on what you can show them, and like people don't really have problem. People's expectations are that, can you actually deliver what you're talking about? Okay, so if you're a trader and then you have a track record that, okay, I can do this, I can do that, and you go and meet anybody, all right, to go and meet anybody that has money, all right, they're not going to have a problem giving you their funds because you have shown them um a track record of what you can do. All right. So if you can do this kind of thing, imagine if you now have like um somebody gave you like $1 million to manage, and at the end of the year you got it to like $5 million, you can easily claim like 30% of that, right? And that will make you a multi-millionaire. You understand? But the reason why that doesn't work like that is because these expectations are not realistic. These expectations right here, they are not realistic. Okay, so we have to tone down the um the kind of unrealistic expectations you are bringing into the marketplace. All right, so if you have something like 5% a month, honestly, that's okay as a trader. You have 5% a month as a trader, you are made, right? Just has to take you a few years. All right, if you have 5% a month as a target, this is enough. So that means that if you're having 5% a month, that will give you like divided by 4, that will give you 1.25% per week that you need to bring in. So if you have only if you only have to make 1.25% per week as your target, you will not be over leveraging the way you are doing it. You will not be overdoing things. Okay, you will not be rushing your trades. You know that okay, this week right now, all I need is one trade that pays me um 1.25%. That means that if I spend or if I risk $100 on this trade, all I want back from this trade is $125, and I'm done for the week. All right. So if you have this kind of low expectations for your trades, there will be no need to rush things or place too much pressure on yourself. Okay. All right, give me 1 minute. I'm coming. I'll be right back. All right, I'm back. So can you guys hear me? Okay. All right. So now, continuing the topic of managing expectations. All right. Please mute yourself. Uh, all right. So if you have that kind of objective, what does that mean? That means that, for example, let's say you have a trade like this. All right. You have a trade. Okay. So your your entry your entry is probably um let me just say that your entry is this other block to the left. Okay. This other block to the left. That's your entry right there. All right. That means that all you need from this trade is just about 2% back. So that means you need it to produce another one. All right. Okay. You need to produce another one like this. All right. And also produce another R like that. So this is if you have this supply zone here, all you need from your trade is just 1, 2 times the risk. All right. So um what I'm trying to communicate to you guys is that you should not have too high expectations. Okay, you don't need to do too much to be profitable. You don't need to overthink it. You don't need to um over expect from the market. Okay, because the more you expect, the less you're actually going to get. All right, so that means that if you have just an objective of like 5% a month, this is all you need. All right, now with what I've taught you now, if you guys should go back to your homes, all right, sit down and think about how to. In fact, later on, shall we are going to develop I'm going to teach you guys how to develop your trading plan. Okay, let me add it. Okay, let me add it. developing a trading plan. Trading plan. Because as a trader now, a lot of people used to tell you have an edge, have an edge, have an edge, but nobody like very people actually show you how to go about looking for that edge. You understand? So basically, I'm going to try and show you. I'm not going to show you the entire way, but I'm going to give you guys clues, major clues that you are going to need. Okay, if I do this, do this, do this, do this, I'm going to come up with something in probably a month or 2 months or something like that. All right, so this is very, very important. Okay, even though I could have actually left you guys to figure it out by yourselves. All right, but this is just basically to make it easier, sha. Just to make it easier. With all these things that you have learned, you can figure it out by yourself if you yearn, all right, if you are thirsty for it, if you really, really want it very, very bad, all right, you can develop your trading plan on your own, all right. But I'll just keep this in here. I'm going to give you guys clues, tips, how to go about it. All right. So yes. So now let's assume that you now have a trading plan. You now, if you have this kind of expectations now, you will not be like the kind of guys that are looking for 1 to 20 R. If I don't get 1 to 20 R, I'm a failure. Okay. No, I'm not a failure. All right. You can have just terrible, terrible trades, not even sexy at all, just basic, just it's not something that you post on the internet and get lots of likes. All right. So most people post trades with likes. In fact, I fall victim to that as well. Once I see an opportunity that has high RR, I want to go and put it out there. Okay, in case if it works out. Okay, so if it works out, I would carry the victory on my head. You understand? I say, hey, I did this, I did that. So it's very, very nice for your bragging rights, but your bragging rights is not going to feed you. Okay, all you need from trading is to um pay your bills, basically sort out your life in the long run, right? So that's all you need from it. You don't need. It's not all this lipstick that is going to pay your bills. Is the actual money you're actually making from it that is going to pay your bill, right? So it's not by drawing sponsor candle, equal highs, equal lows, liquidity, SMS, BMS, MBOS, blah 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 blah. Not by drawing all those things in your chart, okay? The main thing is being profitable, and that's what you should focus your mind on. What are those things that is going to help me? Okay, what are those things that are going to help me to achieve profitability in the forex market or in the crypto market or whichever market you're trading? Those are the things you should focus on. All right. So the earlier you focus on those things, the better for you. Okay. If you go and focus on trying to teach people at first, uh, you would make money from that as well, but you are going to slow your progress. All right. So the time you could be using to learn and perfect your craft, you're using it to pour out your gifts. All right. So you first of all, in fact, if you learn this thing, you notice that teaching is just a stress, just a strain on yourself. Okay. I really, really appreciate all those people that teach. Okay. Like ICT, if ICT did not come out after do his 20 years of research to teach everybody how to trade this way or something like that, nobody will have it, right? Everybody will still be running around doing the normal things, doing the normal trend line, getting destroyed. All right. So anybody that comes out to teach you anything, even if they ask you to pay $2,000, as long as they themselves are doing well with it, all right, and they give you their time, they give you their knowledge, you should be appreciative because it's not actually easy. And if somebody is making money, it's actually a tough decision for them to actually teach, come out and teach. You grab because most times you usually make more from trading than from teaching if you are profitable. You grab. So yeah, basically what you want is that you want to lower your expectations so that you will not put too much pressure on yourself when you are analyzing the chart or checking the market. So your minimum risk to reward ratio can be 2 to 1. All right, you can take a 2 to 1 trade and you should be satisfied. Sure enough, you can find a trade like this, right? You can find a trade like this every now and then. Okay, so probably your trade You traded this one here, right? Sure, yes, you can find a trade like this. Okay, move it up to take your profits up at this probably this high now. Take your profit here. All right. So this kind of trade now, your risk to reward ratio here in this case will be let's check it. It'll be like this is this is 13 to 1. All right. So that means that if you put $10 in this trade and you manage to ride it up to this place, you will be on $130. Okay. So yes, you can find this, but you don't always need to have something sexy, something beautiful, something awesome for you to make money. Okay, all you need to do is to be on the side of the marketplace and to take some profits from the market. I found myself falling for that trap every now and then. Okay, I would be on some profit and I'll be like, this profit is too small. Let's wait. Okay, and profit turn to loss or break even. You end up coming out with little or nothing. Okay, so you have to reduce your expectations, right? You have to reduce your expectations. You have to reduce your expectations. Okay, so don't come into the marketplace trying to overdo or trying to um boast or brag out there on social media. Okay. Yes, you're going to get validation, you're going to get attention, but at the end of the day, those people are going to go to their personal lives, they're going to face your own life as well. Okay. So as long as you are not making money, all those you're bragging is a waste of time and effort. Okay, so the best you can do is just to ignore social media, ignore the Instagram rich traders, ignore everything and work on actually making money. Work on your trading plan, work on your trading rules, work on those things. All right. So in the end, if you can come out as a trader that is making 5% a month, all right, or 10% a month, within a few years, you will get to somewhere reasonable. You might say, oh, so that means that if you can consistently, okay, if consistently the key word here is consistency. All right. So if you know that consistently you can make just 5% a month. Okay, so only 5% is all you can make as a trader. So you're not that good, you're just a mediocre trader. Mm, you're just a mediocre trader basically. We have to notice that even if you are making these low returns, all right, this low return 5% a month, you are better than 90% of traders that lose money in the market. That's what you must realize. Most people lose money. So if you're making money, no matter how small, consistently, you are far ahead of 90% of the traders out there. All right. So if you have this, even if you see that a profile challenge now is maybe 10%, all you need to do is to increase your risk because based on all your models, all your system, your take profit strategies, your risk management, based on that, you are making 5% a month. So with your challenge, you can just increase the risk, all right, so that you can meet up to um, your own personal statistics. All right. So the keyword here is that everything is probabilities, and if you have a high range of trades that you have tested with, you will be able to notice um, what your statistics are. Okay. For example, I was trading some time. Okay, I was trading for some time, and I finally, at the end of like a month or something, okay, I looked at the trading journal, the trading history, right? I noticed that okay, this currency pair gave me the most money, right? It was so clear that okay, this currency pair gave me the most money, all right? This currency pair gave me lesser money, and this currency pair I just had losses totally, all right? Or it was like break even. It was not too terrible losses, but it was just like break even. So you know which currency pair you're good at, okay, or which currency pair you should focus on the more, all right, or which kind of conditions you should focus on. So basically, what you want to do when you're trading is that you need to always record everything about what you're doing. Okay, so record which currency pair you're doing it on, which kind of scenario is it in. All these things you need to note it, especially when you begin, so that in case if you see any kind of success, you know what to repeat. Okay, you know what to repeat. If you just have some success and you did not You did not note, okay, this is what I did, this is what I did to arrive at this point. Then once you get to a point of losses, okay, there's always going you're always going to get to that point. There's no way that you will not experience a losing streak every now and then. Okay. So if you experience a losing streak and that losing streak is not based on um market conditions at that point in time, and you didn't record what you did to get any kind of success, you'll not be able to go back to that point again. You have to start again, trial and error. All right. So it's important to know your stats and to um lower your expectations as a trader. All right. So let me check the next thing. So risk to reward ratio (RRR). I think most of us might know what this is. All right. Risk to reward ratio is basically the ratio of your profit to the ratio of your loss. All right. So um uh how much are you risking and how much are you getting back potentially? Okay, how much are you risking and how much are you getting back potentially from your trade? That's what risk to reward ratio is. That's what risk to reward ratio is. All right. So um that means that, for example, let me take a random trade now. For example, let me take one trade. For example, yeah. So now, I'm going to switch to my. So now look at this. Look at this other block now. Okay, there's another block over here. All right, which could have used as a trade. Okay, and then there's this imbalance right here. This is an imbalance. All right, so if you go on a lower time frame, this area is probably just vacant, or you can basically this is an imbalance. Let's not talk too much. All right, so now if you enter this trade, you're entering the trade at the beginning of the other block. All right, or maybe the middle, the main threshold, if that's what you decide to do. Okay, if that's the strategy you decide to adopt. Okay, so either at the top or the middle of the candle. Okay, but personally I would advocate for the um top of the candle, or wait for confirmation and enter on the confirmation. All right, so now your risk to reward ratio will be that um how many times of my risk will I get at my take profit point. Okay, how many times my risk will I get at my take profit point. All right, so now personally the first place I'll take profit on this trade is here. Okay, I'll first take profit here. I'll first take profit here, right? I'll take profit there because this is an imbalance here. This is a speedy movement. And inside here, there is a sponsored candle somewhere, all right? So um it might react from there. So I might take my first profit there. So now your risk reward ratio will be like, okay, that means from here now, if I'm risking $10, at this point, I'm probably making like $30, all right? So um from there now, okay, from there now, this is my risk and this is my first take profit. Okay, so the first take profit, I'm sitting on 3.19%. All right, so that means that if I'm risking $10 at this first point, I'm sitting on $31.9. All right, so my final target, of course, would be external liquidity. So my risk to reward ratio here is 5. Okay, so now you can easily get trades like this. You can easily get trades like this as a trader based on what I've taught you so far. Okay, you can easily get trades like this. You can see that this trade has 5R without even doing much analysis or putting much effort. If you go down to a lower time frame now, we can refine whatever is down here to something else and make this stop loss smaller. All right, but then without doing much work, this is 5% already. This is 5% already. That means that if I take this trade, okay, I have one of this trade and I lost that trade, okay, and I lost again, lost again, lost again. I lost like 4 times. So I lose like 4 times on this kind of setup, this kind of risk to reward. If I just get one win on this type of setup, I have made up for all those four losses that I made before. Okay, so now the risk reward ratio is important because you want to be entering a trade with the potential of making more than what you are putting in. Okay, so now there are traders out there that will have crazy risk to reward ratio, but try and keep your own um lower, or not that keep it lower. What you should try and do is that you want to uh how would I put this? You don't want to overdo it. Exactly, that's the word I'm trying to look for. You don't want to overdo it. So if the lowest you can refine it to humanly possible, right? The lowest humanly possible you can find it to is maybe like 2 hour or 3 hour. That is still a good trade. Okay. You see some people saying, I don't take less than 4 hour, I don't take less than 5 hour, I don't take less than 6 hour. Mm, you cannot dictate to the market what the market will give you, because the farther your target is, the less likely the price is going to reach there. So I might also say, hmm, look at this whole movement now. We broke market structure here, so that means that I'm waiting for this point right here. I'll now say my take profit to be up here, and I'm having 20, almost 20 R. All right. The more I wait, all right, or um, the more I wait, the less my patience. So if I'm waiting, my patience is getting drained. My patience is getting drained. I'm losing my strength to keep holding on to the trade. And also, the longer I target, the less likely the market may reach there. So that means that um, it is easier for the market to just get to a short objective. For example, now targeting, if you bought here targeting this high only, it is very easy for the market to reach there than trying to target this high, this high, this high, this high. So the longer your target is, the less likely it is to be hit. Okay, so you want to keep your objective reasonable. Okay, I'm not saying you should make it lower, very very low. If you can get a high risk reward ratio from the trade, please take it. All right, but don't try to over refine it or over expect from that trade. Don't try to overdo it. Okay, so if it's only 2 hour you can get, 2 hour is a good risk to reward ratio to use based on what you have been taught. Because based on what you have been taught now, you are going to be taking trades that are higher in probability. So the what comes with higher probability trades is that you don't need to, sorry, it's no longer 50-50% scenario. With high probability trades, you can get as high as 60% to 40 or 70% expectation of profit. All right, so you can easily manage lower RRR. Okay, with 1 to 2 RRR consistently, and you're making profit from most of your trades, you will still be a rich trader in a short while. All right, so now try to manage your expectations. Try to um, make it reasonable, basically. All right, so don't expect too much from the market. Don't expect too much from the market. Don't demand too much from the market. You don't own the market. Your own is to get in there, take what you can, take what the market has offered you, and leave. Okay, use it to bless your family, use it to bless your children, use it to bless the people around you. All right, so that is basically your job as a trader. Your job is not to try and get the sexiest risk to reward ratio, try and make the most money. No, all right, that's not your job. Okay, so learn to keep your expectations lower. So be flexible. What I want to leave you guys with is that be flexible with your expectations and be rigid with your rules. Okay, as a trader, you need to set rules as well. So you need to be flexible with your expectations and rigid with your rules. Flexible with your expectations and be rigid with your rules. All right. So now, risk to reward ratio. We're talking about this. So basically, what you want to do is that you want to keep your risk to reward ratio at a minimum of 2 to 1. All right. So that means a minimum you are getting two times what you are risking on a trade. So if you are having $10 inside the trade, you want to get a minimum of $20 at your take profit. All right. So what that looks like is something like this now. Okay, so something like this. This is 2 to 1. All right. So this is a 2 to 1 trade. So I have my entry here, and my take profit is two times what I'm risking. So this green is profit. This red is risk. All right. So reward versus risk. So my reward is potentially two times my risk. So you can see that this is not very very hard to achieve. This simple objective is not very hard to achieve. So try and keep your minimum to this. Your maximum can be as high as possible, sha. But my own advice is that don't overdo it. Okay, don't overdo it. Just keep it reasonable. Right? So now what you need in terms of results to be profitable. Right? So now, yeah, okay. It's called short position and long position. This one is a long position. This the other one that goes down is short position. There's another one that goes down like this. So depending on the direction of your trade. So you find it here. I think it is see this two here. You can see it here. Long position, short position, forecast, etc. So these are forecast tools. So that's where you find it. So yeah, this is basically how you define your risk to reward ratio. Um, I don't want to. Sure, let me check something. I can't really stay too long as I want to stay today because of certain things. Tomorrow, okay. I want to stop here today. Let's not overstretch. I have to do some things. All right. I'm sorry. These classes are being quite short, but tomorrow we should have a full session. Okay. So tomorrow I'll try and let us get the full 1 hour or 2 hours. Okay. I don't want to um I don't want to rush through tomorrow's topic. So tomorrow's topic, we are going to go inside. We are going to actually calculate what kind of results do I need to make money. All right. So some people think that they need 6 hours, 7 hours, 8 hours, 10 hours, and tomorrow I'm going to be debunking that. So I'm going to be telling you, or I'm going to be showing with our calculator here that we don't really need too much. We don't really need to overdo to make money in the market. You don't really need to overdo. You don't need to, even if you are a bad trader, you can make money. Your cousin can just come somewhere. If your cousin has, if your cousin just look at the trend and say, okay, anytime it comes down, I'll buy. You will not believe it, but your cousin can go and make money even without any knowledge. Okay, because as they're trading the trend, it's more likely that they're going to be on the side of the move. All right, so that's just basically it. Trading is hard, but you don't need to do too much to succeed. You don't need to have too much spectacular results. People think that based on whatever they see on social media, they think that you need one holy grail, you need one spectacular strategy out there that is sitting down somewhere waiting for you before you make money. Okay, no, that's not it. You're not going to suddenly stumble on somebody's training and that person is going to change your life. Okay, if anybody is going to change your life, that's you. It's based on you, what you did, the kind of work you did, the kind of rules you set in place for yourself. Okay, the kind of expectations you have on the market, just all those things, your system, your consistency. That's what is going to make you profitable. Nothing out there you're not going to buy um one crazily skilled trader. You're not going to buy his course today and make money immediately. If you're making money, you know that it's based on you, your hard work, and the kind of rules that you make. You might even buy somebody's course and make money immediately, but it will not last if you don't put in the work to set up certain systems, certain rules, certain principles that you abide by at all times. All right. So basically, how what we're going to do tomorrow, we're going to just check out how much do I need, how many RR do I need to make per trade in to get, maybe I want to get 10% a month or 5% a month. How many R do I need? What is my accuracy? Should I be able to get 3/10, 4/10, 5/10, 6/10, 2/10 to make money? right? So that's basically what we're going to look at tomorrow. All right. So would I think there was one time that I spoke to you guys, and you guys said you don't really know how much you will make per pip on your trade. Abi, do we know? Sure, we know how to calculate the money we're making from a trade based on your lot size. Yeah, it depends on the currency, but yeah, it depends on the currency, but on average, it's close to one particular figure. So some may be a little bit lower, some may be a little bit higher. But you can basically use your brain and just try and estimate it. You were saying something, Wale. What were you saying? Yeah. Okay. Yeah. Yeah. You go with the same time frame. Like for example, now you can see this is the 1 month chart. Now, if I go to Euro USD, you might notice that it is almost opposite at the same area. So let me first mark out the dates. So you can see this thing happened around December 2020, okay, and it reacted on another block that formed January 2018. So I want to just check Euro and see if there's a little bit of correlation in what happened here, right? So if I check Euro USD now, you can see basically the same thing but upside down, all right? So this is January 2018, and this is this area December 2020, or let me just say January 2021, right? So basically the same thing, um just flipped on its head. So this is DXY going up, right? Look at the two lines, and this is Euro USD coming down. Okay, so basically, if I'm looking at the monthly chart, I will check the monthly chart for both, and I'll keep going down on the time frames, trying to look at if there's any similarity. Okay, so for example, I might have an imbalance down here on Euro USD, and on DXY it might be something else, maybe just another block that's sitting down there. Maybe this place is just a straight line up or something, sha, but it will be very, very similar, and you can easily draw a correlation between the two. So yeah, same time frame, and check for similar things on both of them. Yeah, if they're not similar, if they're not similar, that means that something like something called SMT divergence is happening. So for example now, if if this is bearish now, let me say this is a lower low right here. Okay, lower low. That means that on DXY I'm supposed to see a lower high here. Okay, but if I now see a higher high on DXY, I'll believe that that higher high is just a scope, all right? It's just a tactic. It's just taking out liquidity, and they're going to go lower. So that's going to be my belief, all right? So that means that um, Euro USD is weak, all right? And whatever thing is playing out in one of them. I may talk about this in later, Sha, but I don't think we'll have that time. I'll just refer you guys to a video to check it out. So SMT divergence is just basically where one of them is not correlating with the other one. So if this one forms a higher high, I believe that that higher high is just a trick, and price will still go down since the other one did not form a lower low on the other side of things. So yeah, yeah. So it's just a sign of manipulation basically. Any other question? Okay. With that, I'll close today's meeting. I'll see you guys. Today's a Friday, so we'll have a class tomorrow by 8. I think so. I think if I don't have that class I'm having normally, I'll have a class tomorrow by 8. But if I do have it, then I'll communicate a new schedule to you guys. But let's see how we go, Sha. I'll see you guys tomorrow. Take care. End of the meeting. Good night.